RBI policy today marks the second day of deliberations by the MPC. The outcome will be announced tomorrow by the Governor Sanjay Malhotra, and it's being tracked closely by markets, of course, for decisions on interest rates and their impact on equities. To discuss expectations on rates and the growth outlook, we're joined by Indranil Pan, Chief Economist at Yes Bank. Indranil, good morning. Everyone's hoping for a surprise, but do you think the RBI will be a little prudent or be dovish and go ahead and really give everyone a festive boost?
I think from my perspective, I would expect RBI to be more on a watch and wait mode at this point in time. I think the amount of uncertainties that the RBI would be struggling through at this point in time is quite significant. On one side, you have the tariff, which we have not really seen a clear resolution on. On the other side, we have had GST cuts, which is likely to boost consumption to a certain extent. And the GST also has brought down the prices quite significantly, or is expected to do so. My perspective is that because this is a policy-led sort of dip that we will be expecting in terms of the prices, the RBI needs to see through it. The GST cuts and the built-in consumption boost that we are expecting in the absence of a clear uptick in terms of the private investments demand could actually turn out to be relatively inflationary on the core side. And therefore, the RBI would have to weigh the growth versus the inflation perspectives of all the policy changes that are happening before taking an incremental decision on rates tomorrow.
Okay, fair enough. I also want to ask you about some of these draft changes that the RBI has recommended and the kind of impact on that, talking about more flexibility for borrowers, for banks, easing lending norms. What do you make of the latest rules that they've suggested for more flexible loans for borrowers, wider access to credit against gold, and easier capital raising avenues for banks as well? I would just love your comments on that. It's, of course, still a draft in the making.
Well, I think obviously India being a developing nation would actually have to very significantly rely on domestic savings for its journey towards the future growth. And the reason I say so is that there are significant tectonic changes that are happening in the global scenario, and there's a huge amount of policy reset that is happening. And very clearly, when there is significant amount of uncertainty in the global atmosphere, the mobility of capital also tends to suffer, which is very clearly evident in the balance of payments data that we are seeing today, with a lower FDI, relatively muted FPI, low ECBs, and therefore a slight reduction or a slight muted reliance of India on global capital. And now that clearly brings to the fact that we need to harness domestic savings in a
Right.
very significant way. And that is how credit offtake is likely to happen. But unfortunately enough, we have not seen private investments pick up. So from the asset perspective of the banking sector, corporate loans is not really picking up, and therefore the reliance in terms of growth of the lending sort of book, we still have to rely on personal consumption expenditures. The critical ones are obviously the housing, which should provide an upside because of the interest rate cuts by the Reserve Bank of India, the reduction in the cement GST, etc., could actually provide a push to the housing sector. On the other side, we are expecting the GST cut to also provide a boost in terms of white goods, and that is where I think the personal loan of the banking sector would actually be playing a part. And to a certain extent, the overall dampening of the personal loan space was on account of the regulatory tightness. That, to a certain extent, therefore, it is sort of likely enough for the Reserve Bank of India to reduce that to provide that push in terms of the
Sure.
lending side.
Okay, so clearly a lot of action wanting to be seen on the lending side. Now, markets are pricing in quarter bips of a cut. That's what Dharmesh also said. You're saying they're going to hold. Everyone's waiting to see what happens. If they do hold, what's your outlook, Indranil? What do you suggest the central bank will perhaps indicate in its commentary?
I think along with the hold, they should also stay on a neutral stance. And I think this is possibly not the time where you have a clear forward guidance for the market. That's
Okay.
something that may be actually negative if you are looking at the GSEC yields or how yield setting happens in the domestic economy. Yesterday
Sure.
also we saw the 10-year G6 moving quite high, and it actually went close to the 660 levels. So to that extent, it may be actually negative for the GSEC yields, but I
Okay.
wonder whether, given all the uncertainties with the data that we are talking about, and despite the fact that inflation is close to the lower bound of the flexible inflation targeting regime,
Yeah.
we can see a very clear guidance from the Reserve Bank of India, and they should clearly indicate to the market that it's a wait and watch mode for them, and clearly tracking data to decide the future course of action, without, of course,
Okay.
closing the door fully on future
Okay.
rate cuts and expectations of that.